Welcome to another 21 Hats Dashboard. I'm Lauren Feldman, and I'm here with Tracy Bech, who is co-author of the 60-Minute CFO and host of the brand new 60-Minute CFO podcast. Welcome back, Tracy.
Hi, Lauren. Thanks for having me.
Always a pleasure. Tracy, you have a brand new podcast. Tell us about it.
I do. So it is a podcast mini-series is what I'm calling it. And in true 60-minute CFO fashion, it's meant to be short and sweet. So I haven't added it up exactly, but really, truly, all of the episodes combined aren't much more than 60 minutes. But it's meant to be just short, actionable primers in the various topics that we teach at 60-minute CFO.
And it's aimed at?
It is aimed at small business owners and really helping small business owners become more financially fluent.
So more beginners or the whole range, or anybody who feels a little unconfident in their financial knowledge, which is a lot of business owners.
Yeah, it's that. It's the last piece you mentioned there. And it's really meant to be, we always try to foster a no judgment zone. And so many of us as small business owners, myself included, do not go in to business because we're excellent at business finance. So, but yet the stats show that most businesses fail because of poor financial management, not because of a great product or service. So it's really aimed at all of us, right? And if we can, even if you consider yourself advanced, I also always say no one person knows everything there is to know about business finance. And it's also a muscle, right? And the more you use it, the stronger it is. So, I think if I do say so myself, I think it could benefit almost everyone.
So you're telling me you think there's a market for a podcast aimed at business owners where the host actually knows what they're talking about? Is that what you're saying?
Yes, if only that existed, Lauren.
Oh, I think it does, Tracy. We've spoken before. But it sounds like a risky proposition to me. I'll let you in on a little secret. It's a lot easier to ask questions than it is to try to answer them. So be careful about that.
I hear you.
So let's, if you are okay with it, I'd love to talk a little bit about a couple of episodes that I listened to, including the first one, which is about cash flow and financial management. Give us a quick overview of what that one's about.
Yeah. So really, we're just highlighting the fact that most businesses fail, period. Right. And so by year 10, only 30% of businesses that started 10 years ago are still standing. And the main reason isn't, like I said before, bad ideas or a lack of customers. It's really just basically, in simple terms, running out of cash, right? Cash flow and financial management. So the problem is we oftentimes confuse the difference between profits and cash, and they are different. And the other problem is that our financial statements don't really tell us what our cash position is unless we can read between the lines. So we talk about the importance of taking a look. If we're not paying attention, the first piece is to pay attention to our financial statements, right? And then at 60-Minute CFO, and I'm sure we've chatted about this before, but we're really talking about not just looking at numbers, but the relationship between numbers on your financial statements. And this is going to start getting you closer to understanding what's really going on, because numbers can be deceiving.
Let me stop you for a second there. I know some listeners are panicking at this moment. You're talking about ratios and math, and there are a lot of people listening who have probably used the phrase, I'm not a numbers person. In the podcast, you use a good analogy. You compare it to driving a car, where to drive a car, you don't actually have to understand how the engine works. Can you reassure people that this is not beyond them?
Oh my gosh, exactly. So the analogy is that you drive your car, but you probably don't understand how the engine works necessarily, unless that's your, profession or hobby. However, you do understand how to read the gauges. You know how fast you're going. You know how much fuel is in the tank. You probably know how many more miles you can go before you run out of fuel. If the engine's overheating or not. There's all of these indicators on that dashboard that over time you've learned to read, right? And So even just miles per hour, that's a ratio, right? It's a ratio of how many miles you're going over time. So if we were just to tell you how many miles you went in your car, that wouldn't necessarily give you all the information that you need. And if we told you how long you've been in the car, that wouldn't necessarily give you all the information that you need, right? But yet that's kind of the information we get from our financial statements. Your dashboard on your car is giving you a ratio of miles per hour, right? And that's a lot of what we do at 60 Minute CFO is we make more meaning out of your numbers by comparing numbers against each other that exist in your financial statements, but not until we go in and calculate the ratios, right? So yes, if you are not a numbers person, please don't be scared by the word ratio. You've got this. If you can drive a car, you can do this.
You mentioned the confusion between profit and cash flow. Many of us have heard that it's possible to have a profitable business go out of business because of cash flow problems. Have you actually seen that happen?
Oh, yeah. What I like to explain is that there are only two drivers of cash on your income statement, right? And if you're a business owner, you might also call that your profit and loss. And it's again, there's some metrics on there that we all know and love, right? We track our revenue. Everyone's excited to report back on their revenue, and we're excited to talk about our profits. But a profitable business can run out of cash because cash and profits aren't the same. And yes, we get cash from having profits, but we also need to use cash to do things on the balance sheet that would not show up at all on our income statement or that profit and loss statement. So, for example, you might have an inventory-based business. So if you're in retail and you have to buy inventory, right? So if you're buying goods that you're going to then resell, those are bought with cash, but it doesn't actually deplete the profits. It's shown as an asset on your inventory, in your inventory on your balance sheet. So you might see a lot of profits, but that cash in your bank account will not be there because you spent it to go buy t-shirts or widgets or whatever it is that you sell. So if, for example, you're only looking at profits and you're thinking, my goodness, we're super profitable, but then you click over to the bank account balance and it's not what you need it to be. We're looking at what's, a deeper analysis that we need to do, which is going to pull in the balance sheet, which, I myself have a whole story about almost growing broke in my inventory-based business because of this exact situation. And entrepreneurs were not excited about looking at the balance sheet. So the balance sheet can hide a lot of ways that we're using our cash, and the income statement can make it look like we might have a lot because we do have profits. And then the other piece that can really affect our cash is we might be showing revenue and profits, but our cash might be tied up in accounts receivable, right? So the timing can make a big difference as well. So if we're not collecting as fast as we should, we would have money due to us, but it is not in our bank account. Now, that's an issue when it comes time to pay our staff and pay our bills, right? The money is technically ours, but we don't have it. So it can create a cash crisis. And if that goes unchecked for a long time, that's when we can see a real struggle, right? And businesses that are technically profitable and doing just fine just aren't aligned on the timing of the cash. So yes, those are just two ways to have that happen.
I think you mentioned in the podcast that there are some signs, red flags that you can look for if you are in a difficult cash flow situation and maybe haven't realized it yet.
Yes, you definitely can start doing things to give yourself a little bit more visibility into what might be going on with your cash. So we can, we can look at our profits, and then we can start to talk about really, okay, now, what has been our cash balances? I think I recommended really actually pulling your balance sheet if you haven't looked at it in a while. And when you start to do that, if you pull a balance sheet, let's say you pull one from today's date, and then you pull one from a month ago. And maybe then you pulled one from a year ago. And you can look at the cash. Cash is listed on your balance sheet as one of your current assets, right? You can start to see what your cash balance looks like in your company. You could do it month over month for a whole year. And you could really start to see what that looks like. And you'll notice variations, right? Once you've learned that, you're probably going to be able to see maybe a pattern. Maybe you have a bit of a cycle or a seasonality to your business. And you might be able to say, like, every June, we run out of cash for whatever reason that might be. There might be a myriad of reasons. And we then want to start anticipating running out of cash, right? We want to start building up and understanding, without going into, too many jargony words, but like, what's the appropriate amount of working capital that we need to keep and sustain in the bank, in order to sustain periods of low cash. And then let's start to analyze from there, how we got there. Like, why is the cash lagging? Is there a way we can speed up our accounts receivable? Is there a way we can get vendors on a better, or our clients on a better payment schedule? What are some of the things that we need to do to really shore that up? So it takes a little bit. And cash flow, when we teach this, it's usually after we've done an in-depth income statement and balance sheet deep dive, so you can really understand what's going on there. But I think intuitively that resonates, right? We can start to predict, oh yeah, there is a bit of a cycle here, and there's going to need to be a bigger emphasis on looking at what really is going on with the cash so we can anticipate shortfalls.
To some extent, I think you're talking about kind of projecting the future here a little bit. You're by looking at your past experience, seeing the ebb and flow, understanding when you may be likely to fall short and preparing for it. That projection is another thing that I think a lot of business owners struggle with. They just don't know where to start. Can you offer any guidance on getting started in projecting your future finances?
Yeah. So I get this a lot when, again, when we teach in our live cohorts, or when we, whenever I really meet with clients, we always talk about the 3 steps to becoming financially fluent. And the first one is learning those key ratios that are really going to help you out. So really understanding your dashboard of your car, right? What are the gas gauge and the speedometers of your business. And then we talk about the difference between cash and profits. And so that's really appreciating the difference between, or the interplay between how money shows up on the income statement and how it shows up on the balance sheet. And then the third piece is learning how to forecast. And people go, well, I don't know what's going to happen, and why bother? Because we're really kind of too busy to do this. We don't really know how to do it, and it's going to change anyways. So what's the point? And this is where I always like to remind them that failing to plan is planning to fail. So just like if we're going to stick to the car analogy, we are going to not get in the car and say, hey, we're going from, I always use the example of, I live in the Northwest, and if I'm trying to get to Texas, I'm going to plug that into the GPS, right? So the first step of planning is figuring out where you'd like to go. Right. And kind of like figuring out, like,
I like that.
Yeah. What are we going to do? And you wouldn't certainly get in the car and try to get to Texas without plugging in that endpoint. So kind of, you give yourself a little bit of some guardrails, like, we're trying to get here. And then it's not really that hard or glamorous. It's just guessing. Right? We don't know what's going to happen. But we can guess. And especially once you've started to understand kind of how I said you can point out patterns in your business, you can kind of understand history, you're going to be able to get a little bit better at understanding the future as to what's likely. And we have templates. If you go to 60minutecfo.com, there's a downloadable Excel sheet there that actually has forecasting templates on it. And you can just literally kind of create what we call a pro forma income statement and a pro forma balance sheet, just guessing at what these revenue buckets might be, what your expenses are going to be, and then that'll give you your profits. And then same thing on the balance sheet. How are you going to allocate your assets? What kind of liabilities might you have? And the 2 combined are going to give you your cash flow. That's actually derived from those 2. And before you know it, you kind of have a plan. And really, I always also tell people, like, this is not a, like this perfect masterpiece that you're going to hang on the wall and gaze at lovingly. It's a working organic document, right? You're going to revisit it and you're going to, oh my God, what was I thinking? This is wrong. Okay. Let's take it, like if we're on the Google Maps metaphor, we ran into construction, take a detour. Here's where we're going now, right? Like, you're going to change this the second the ink dries, it's going to change. So we got to let go of that desire for perfection when we make a plan, and we just have to get our hands dirty and muck around in it. And believe me, it is worth the mental exercise, because you will unknowingly have prepared yourself for all kinds of scenarios, so that if and when those happen in the coming 12 months, rather than coming up with strategies from scratch, you're going to fall back on some things you've already thought through. So it's a really great exercise, and I definitely recommend. It's definitely the third step, right, of becoming financially fluent.
You did another episode, I think it was your episode 4, where you talk about misunderstood metrics, and you have an example in it that I liked. You talked about how owners tend to focus, understandably, on the bottom line, their net profit, and that if it's not what they were hoping for, their usual reaction is to try to improve it by increasing the top line, increasing revenue. Tell us, what's wrong with that?
Well, this top line, bottom line method of management is all too common, right? It's exactly, those are two.
I was going to say, I think everybody I talk to does that.
It is. It's, if you are listening and you're thinking, what the heck is wrong with it? Well, there's nothing wrong with it. But the problem is they can be misleading. And the trap we can set ourselves up for is ignoring the other two levels of profitability that are in the income statement. So the net profit, which we refer to as the bottom line, is actually the third level of profitability. The first level of profitability is our gross profit margin. And the second level is our operating profit margin. So there's 3. There's gross, operating, and net. Now, if we're just trying to become more profitable and we're only ever looking at the top and the bottom, the only two things that we're really thinking are, how can we cut, quote unquote, some expenses, right? And we're not being strategic about which ones. Or we're thinking, how can I increase the top line? How can I make more money? Which hopefully we'll make more at the bottom line if we do stuff right at the top line, right? And yeah, sure, that works, but it's going to be the least efficient way to go about increasing our profits. Because if we come in strategically and we analyze the 2 other levels, and also if we can add in a little bit of knowledge about maybe how our industry performs, we're going to get a lot more insight, right? So for example, gross profit margin is the margin that we make on the cost of doing our work, right? So if you're a service-based business, that's your cost of sales. It's how much you pay people to do the billable work in your company. And if you are like an inventory-based company, or you have goods, it's your cost of goods, right? And if there's a broken link there, if we're not making enough money at the gross profit margin level, we don't have enough to operate with, right? So we're kind of screwed, from the top, right? Like it's going to be very hard for us to cut all those operating expenses, like, how many paper clips we're buying and how much our office rent is and how much the managers are getting paid, if every time we sell a good or service, we're not making enough money. And that makes it even harder if our instinct is to go out and earn more money, because the same problem will exist in perpetuity.
Just to make sure everyone's clear, you told us about net profit. You told us about gross profit. What's the difference between gross profit and operating profit?
Right. So operating profit margin is our second level of profitability. So after you have paid for your cost of goods and or services, what's left is your gross profits. From that, we pay for all of our operating expenses. And operating expenses are, sometimes you can also just think of them as like everything else, or general and admin. It's anything that you need to pay for to keep the lights on at your business, but does not go towards providing your goods or services. And yes, we still want to optimize all of these line items. But if the gross profit margin is too low, it's going to be very hard, right, to operate our business with not enough operating profits. So but we can still nonetheless optimize it. And then what's left after we've paid for our operating expenses now comes out anything that is non-operational in nature. So those are things like interest expenses, maybe interest earned. If you have a sale of an asset that isn't really, in line with what your business actually does, you would recognize that as non-operating income. So there's just a little bit usually that comes in below that line that then contributes to our net. So you can see that if we skip, and we're only ever talking about net, which is bottom line, and top line, which is revenue, and we glance over what's in between gross and operating, we might really miss some levels of detail here that, especially if the gross profit margin is off, it's going to be so hard to out earn that loss. And we could just we could overwork ourselves for still not the right amount of profit. And so in that way, we really talk about like, that might be the wrong level of profitability for you to focus on, right? It just can be very misleading.
That's very helpful. As I listen to you, it occurs to me that I know, as you said before, there are a lot of owners out there who this is not why they went into business, and they just struggle with diving in and accepting that they have to deal with this. Is there... What have you seen work best for someone who's really lacking in confidence and hesitant to take that leap? What can get somebody over that hurdle?
Well, certainly read our book.
And listen to your
Shameless plug. Listen to the podcast. Sign up for a live training if you want that accountability piece and, just people really walking you through it. But it's a mindset thing, right? So like so many things in business are. And it's really just a decision that you get to make that no matter what, you are going to start adopting that mindset that this is a topic that you can understand. And one of the things that I think is really important is to give yourself that beginner's mindset, right? Like it's a journey. You're not going to come out after reading our book one time, a financial expert at your business, but maybe you did gain 2 nuggets that are really going to help you. And those are 2 things that you didn't understand at all before. And so it's an iterative step-by-step thing. We always say, I think I end almost all my trainings with this is a journey. It is not a destination, right? So just hop on and see what resonates for you. See what little aha moments you can uncover that are going to really help drive your business forward. Detach from any kind of this like, whoa, is me, or why didn't I do this sooner? Or I can't believe this is the way it is. And I didn't pay attention. None of that serves you, right? And you're actually in the majority, right? Most people aren't doing this. So just join the small percentage of people who do. And also then take yourself out of that stat where, most businesses fail because of this. It's just the thing that I always find really inspiring about that stat is they aren't going out of business because of a lack of product, a viable service, or customers, which, I think it looms large in our mind when we go out and launch our businesses that those things will be scarce, right?
Sure.
So if you've gotten this far, you're doing great. Just don't let this small piece of learning really ultimately take you down, right? There's no need for that. And the smallest, little simplest things, if we can, go from understanding miles and hours to miles per hour, you're doing great, right? It's little learnings that make a big difference.
Tracy Bech is co-author of the 60 Minute CFO and host of the brand new 60 Minute CFO podcast. If for some reason you want to try a podcast where the host knows what they're talking about, you might want to check it out. Thank you, Tracy.
Thank you, Lauren.
Have a great week, everybody.